Somebody who understands the space extremely well is joining us now. Srinivasan, MD of Kotak Investment Advisors, is here with us today. A lot of interesting things happening at your end. Srini, good afternoon. Thank you so much for your time. Let me start by chatting with you about the exciting part. You have a veteran banker joining you as an advisor for a new fund. I'm talking about Mr. Rajneesh Kumar, whose bulk of heavy lifting at SBI started showing colors and fruit of his hard work in the recent results gone by. And he of course understands corporate India very well and all the stressed areas, and you plan to start a new fund with along with him. Talk to us more about it.
Actually, not a new fund. We already have a fund, which is a $1 billion fund that we have raised from global institutional investors. We have in fact already started making investments out of that fund. And since it is a pretty significant fund, we felt that we will benefit from Mr. Kumar's expertise and experience, and his tenure in SBI, and having a ringside view of corporate India and the connectivity that he brings to the table, as well as the wisdom that he brings to the table, will be of immense benefit to the fund that we have already raised. And if the government's plans with regard to consolidating the loans under the ARC comes through, then we do believe that funds like us will be very busy looking at a number of stressed assets. And so that would be the appropriate time for us to gain enough knowledge and experience to bring on board.
Shini, give us a flavor of what kind of investments are you really having on your magnifying glass? What kind of opportunities are you seeing in the stressed area where your money from the fund can actually turn out to be instrumental in turning around the asset? And how, what kind of IRRs would you make there? What is the opportunity which you're looking at?
It's an interesting question. So from a fund perspective, we have a pretty wide mandate in terms of what kind of investments we can make, all the way from structured credit to buying assets under the IBC program. As we speak today, we have made one investment where the company had already gone through a CDR, and it was still paying down the CDR lenders. And as you know, in the domestic market, as long as the balance sheet of the company reflects the CDR lenders, the company cannot go back to the formal banking market and get additional money for whatever business plans that they may have. So it was important that the existing CDR lenders are fully taken out for the company to be brought back on even keel. So we made an investment in that company of about 450 odd crores. The CDR lenders had also taken an equity in that company. So we bought off the equity as well. And that's what we have done in this case. And the company is in public domain. What I'm telling you is in public domain. The company was Jindal Stainless. And we made that investment almost a year ago. And since then, the company has done extremely well. Yesterday, the quarterly results came about. And the company is generating very good free cash flow. And it now has the ability to sort of consolidate with its other companies. And that's done pretty well for us. That's one of the investments that we have done. We have also bid for assets under the NCLT program. And we have already got a favorable order from the NCLT awarding us one of the assets which had gone through the IBC process. And we should be taking possession of the asset in the next couple of weeks as we end up making the payment. That's another 450 crore kind of investment. So there are a wide range of opportunities that we can look at. We are in advanced discussions at this point in time to provide a one-time settlement capital for a company which has about 1,500 crores worth of debt. And we are providing a one-time settlement amount of nearly about 750, 760 odd crores. So the banks will recover 750 crores upfront, and that will go towards the one-time settlement of the loans of the underlying company. And thereafter, the company will continue to perform, and where there is additional capital required by the company, we will provide that as well. So it's a very flexible approach. So we've been busy. Yes, thank you.
Right. Shrini, we understand that you're also raising a real estate focused fund once again. Real estate now, interesting data points seem to be suggesting volumes are moving. Various state government along with low rates and government incentives have led to a lot of buzz in various developers, various ends of the pockets. any listed developer you speak to talks about inventory getting cleared, all of that. Well, even on the stress side too, there is activity happening in real estate, and look at how real estate tilted NBFCs are active in trade right now, as if they are, breathing back to life. How is your analysis? What's your analysis of real estate right now, and what is the opportunity you are eyeing via this fund?
See, we recently announced the closure of our new real estate fund of about $380 million. The construct is that we will broadly look at more credit-oriented transaction. We do have some flexibility to take underlying equity risk. I think what you're referring to is the recovery in the residential real estate market. Yes, certainly, after the price reductions as well as reductions in stamp duty in cities like Mumbai, there has been a significant uptick in terms of volume on sales. And in Mumbai, what we have particularly observed is that because of the stamp duty reduction, high-value real estate transactions have moved and inventory has been cleared pretty quickly. There is still a very significant amount of inventory overhang, particularly in the more higher end of the market, in a market like Mumbai. And the reaction or the volume are somewhat less dramatic in the other markets. Having said that, I think the challenges that the earlier loan book of many of these NBFCs are not fully over. And there are many opportunities for us to provide a holistic solutions to these situations, which is what our latest real estate fund will address in the market. In addition to the fact that we are looking at other new developments with partners who are now survivors. As you know, many of the other real estate developers have gone through very challenging times. Many may not survive. And those who have survived will require growth capital, and we think that we can address that issue as well.
Srini, your thoughts on, because you've seen the entire value chain of, capital market, how are you really analyzing the action in the real estate, in the listed space of capital markets? A lot of IPOs also lined up. The market is quite active right now. Both the large caps and the mid to smaller caps, equities are at lifetime highs. And the consensus is that next 2-3 years, the earnings upgrade cycle will continue. And structurally, there's a case for expansion because of low rates, global liquidity, as well as earnings rebound and government reforms coming into place. Do you see that hypothesis getting challenged, or do you broadly agree with that? What are your thoughts?
Look, I think given the way the economy has performed over the last 2 or 3 quarters, and if you see the numbers of many of these companies, it looks like, we could potentially be hitting a sweet spot in terms of potentially, hitting much higher growth numbers than what was predicted in terms of doomsday prior to COVID. Secondly, I think the budget is a fantastic growth-oriented budget. And if the government follows through on the policy decisions that they have made with regard to investing in infrastructure, that has a domino effect in the market. Coupled with that, the uptick in real estate, which also has a multiplier effect in the market, there are every sign that we may be entering into a pretty significant growth phase, which means the numbers that you talked about in terms of upgradation of numbers, there is a high likelihood of that happening. So all of this augurs well, and this is all happening at a point in time where the rest of the world is actually struggling, and the rest of the world is awash with money. So if you can look at the kind of money that's flowing into the country, and the debottlenecking in the latest budget with regard to attracting long-term investors into infrastructure assets is a very big positive. So if you look at the listed market today, the government's privatization program as well as asset monetization program will dramatically increase the overall size of the market. Till 2 years ago, we did not have an asset class called REIT in this country. Today, we now have very large REITs already listed. And I would say that as the government progresses with its asset monetization program, there will be many more options, both in terms of REITs and InvITs. So that's going to be a separate, yield class in the yield plus growth kind of class of investors. investment opportunity that's going to come up in the market. So all said and done, we are going to see a much expanded capital markets. And, this morning, I think one of the press was reporting that a number of these startup companies are going to get listed. I know that SEBI and others are working on regulations to try and make it attractive for some of them to list either in India or in the GIFT city. If all of that plays through, we're going to see a very, very significant amount of capital that's going to come into the country. So it is going to be a pretty strong bull market for the public markets over the next 12 to 18 months.
Srini, that's a very positive endorsement coming from you, someone who's seen listed, unlisted, all kinds of asset classes for over 3 decades. A quick, parting word on the private equity space, which is attracting huge capital, both from affluent Indians, family offices, etc., plus global overseas investors as well, piling in. Where is the interest, apart from real estate and infrastructure, for this kind of money?
Adesh, I couldn't hear the question because there was an internal communication. Somebody was speaking and I couldn't hear your question.
Right. No, I was wanting to understand your thoughts on private equity space. Where is the money going there in terms of sectors? Which are the sectors in your view which are looking attractive for private equity flows?
Obviously, right now with the economy poised to grow, opportunities are there across the entire spectrum. The startup world obviously has been doing a phenomenal job, and that will continue to attract capital. And many of the mature companies, which are the unicorns or soonicorns, as you can call it, are going to raise further rounds of capital. And with the economy rebounding, there will be a fair amount of capital that will come into those sectors as well. But the usual suspects in terms of which are of interest to private equity investors, which is the services sector, the pharmaceuticals, specialty chemicals, will continue to be interesting. And I do hope that these measures will now shift the focus towards the manufacturing companies with all the incentives for production link incentives. Manufacturing is likely to see more interest from private equity, which was somewhat missing in the last, let's say, decade or so. And I do expect manufacturing to pick up given the fiscal incentives that are being provided. So it's going to be a pretty wide range of industries in which people are going to be interested. Commodities and those companies which are not necessarily ESG friendly are the one which are going to suffer. There's going to be a significant money moving away from anything that is not going to be planet friendly in the current environment. On the contrary, anything that is planet friendly is going to see a tsunami of money chasing those opportunities.
Right, Srini, always great to have your thoughts. Thanks so much for your time today.
Thank you.
With that, let's take a short break. More stock-specific news and analysis on the other side.